love sitting down with Randy. I get to do this about once per year. Last year I sat down with your CFO and I got a corporate update on the company. You know, I have this conversation every year at this conference because we're seeing more and more new folks arrive at this event. Last year when I polled the speaker hall and said, how many of you are here for your first time ever? It was about 30%. Yesterday morning when I did that, it was a clear 50% of people who, let's do it right now, just find out if I'm full of crap or not. If this is your first time at my conference, would you mind giving me a wave? Let us know. Look at that. It's phenomenal.
That's impressive.
Thank you for coming. I really appreciate it. So the reason I want to sit down with Randy is because this business is really high risk. It always is. And I love it, right? And it's, you're here to learn and do your diligence and make smarter investment decisions. But in this industry, it's great to have a few anchor positions, right, that provide you a bit of ballast against the volatility. Most of those companies do not generate income. They raise money, they put it to work, and they hope to create value. But in this industry, there are some companies that create tremendous amounts of cash, Wheaton Precious Metals being one. So last year I sat down with your CFO, and let's just go right to it. So Wheaton Precious Metals was generating last year around $1 billion in operating cash. This year it's over that with the price of gold. The message was, we're going to go shopping, right? We have some cash in the till, and we're looking for ways to deploy it. Let's start with that question, but before you get to it, Randy, just because there's so many new folks here, give us the elevator pitch on the business model, and then we'll walk into this year's details.
Sure, sounds good. And thanks, Jay. I always enjoy sitting down with you. So Wheaton Precious Metals created the streaming model 20 years ago. We just celebrated our 20th anniversary last October. The streaming model is a very unique way to invest into the mining space. And basically, I'm a geological engineer, and we actually created the streaming model to generate capital for Goldcorp. I was working at Goldcorp at the time, and we needed money. The mining industry needs capital. It is a voracious consumer of capital, and that's what our business is we supply capital, but we supply it by purchasing a share of the production. Now that works really well if you select good mines. That's the biggest challenge. A wise man very early in my career told me the most important thing is to stay away from the bad mines. Not so much picking the good ones, but which ones not to invest into. And so I think that's the one thing that set us up well, is that at Wheaton we put a lot of focus on high margin assets where our operators, our partners, our operating partners are also very profitable. We get a share of that production, but we also get a share of that of that growth and that reinvestment that they have back into that. And we've built an incredible company that now has over 40 assets, or close to 50 assets around the world. 18 of them are currently delivering us metal. We've got about another 10 coming in. We've got an incredible growth profile going forward. But the huge advantage of the streaming model, and this is why it's as you say, a foundational investment that should be a form of foundation of everyone's precious metals portion of their portfolio, is the fact that we don't have cost risk. You know what our capital cost is. That's the upfront payment that we make when we make the acquisition of the stream, and our operating costs are defined. And so the biggest challenge, the hardest challenge, and I'm an operator, I come from the operating space, I know how hard it is to deliver on your cost promises. That's the biggest risk in this space. Is companies being able to deliver on those cost promises, those capital cost promises and those operating cost promises. That's not a risk at Wheaton. Our costs are defined by contracts, so there's no surprises. And so what we are is a company that's last year probably somewhere around 600,000 gold equivalent ounces of production, the bulk of it from precious metals, which makes us unique in our peer group space. About 98, 99% of our production comes from precious metals. 65% of that is gold, another 30% silver. It's, as you say, a foundation that you should have at the core of your precious metals portfolio.
So I want to highlight a couple of things here. First of all, Randy's doing the same thing that we're all doing. He's looking for the best investment opportunities in this business. And what he does is provide some capital, just like we do, to companies that produce metal, and he buys future output of that from that mine. And what I love that you shared is you're like, the job isn't necessarily to pick the winners, it's to avoid the losers, right? And we talked about that a lot on stage yesterday. It's way easier to get the losers off your desk and then look at the possibility of success with what's left.
Yeah, and some of it comes down to the right assets, but a lot of it, I mean, there's some good assets out there that have outside challenges that have come into play. And so it also comes down to how we structure the transactions. And we've been doing this for over 20 years now. And so we've got a lot of protections in our contracts that would avoid, when we have governments come in and shut down operations. One of our biggest peers, of course, is suffering with that in Panama right now. We don't sign deals like that. We have compensation factored into our transactions, and so there was no parent guarantee offered. We wouldn't take that deal. It comes down to finding the right assets, but also putting the right structures in place so that we don't take on risks. As I like to remind everyone, we stream gold, we stream silver. We don't stream political risk. We leave political risk with the operators, and so structure is just as important in terms of how we build our portfolio.
And when he mentioned that what he gets in exchange is future gold production and the growth of the company, that's because Randy takes a % of the gold output, and as that mine continues to invest in further exploration and increase the size of their reserve, the mine life grows, and Wheaton Precious Metals gets to participate in that for the fee they may have paid years earlier.
The transactions are all life of mine, and so if we select well, that can be a very, very long time. We particularly like underground operations because underground operations is very tough to define that reserve and that resource. It's very expensive for companies to step out, but when you study the geology of the area, you get a good sense of the exploration potential of these projects going forward. And we've got mines in our portfolio that have well over 100 years of operating history, and they're still going. They've got bigger reserve and resource bases than they've ever had, and those are the type of assets that are great to invest into. But yeah, we get a percentage of whatever that mine produces for the life of mine. And the hopes are that the life of mine is longer than what we originally bid on, and that you see some exploration growth and even some expansion potential on these assets.
And the last thing, I feel like I'm just recapping everything that you're saying up here, but when he talked about cost control, right, his costs are fixed. That's because he'll do the deal today. And I mean, if the price of gold goes up, as we've talked about many times on that stage, the gold hasn't changed. It's the measuring stick, right? It's the currency that we measure gold in. So if the price of gold goes up as we continue to devalue currency, the price of everything else goes up too. And so all those input costs that the mine requires to produce more gold go up as well. So margin can get squeezed even when the price of gold goes up. Randy's exempt from that because he's done the deal at a fixed price in advance, and everything that comes after that is in that initial deal.
I hate to say it, but it's even worse than that. Higher commodity prices will always bring lower grade material from the waste pile to the ore chute. And so as soon as that lower grade material comes in, you're also automatically going to get a higher cost on a per ounce or a per pound basis. And keep in mind, when I say per pound, just about 60, probably 65, just about 2/3 of our production comes from copper mines. But we get gold from those copper mines. We're buying the non-core byproduct production. But, when you see those lower grade or higher commodity prices, that does bring higher cost materials, i.e. low grade materials, back into the economic equation, and it pushes forward. So not only did you have the inflationary pressures that come along with those higher gold prices that push costs up, but you're also going to be chasing lower grade material at most mines. We're generalizing here. Every mine is unique, and you have to study the mine itself. And so cost pressure is real. I think that anytime you have commodity prices jumping drastically, it's just about impossible to promise cost efficiency. You're always going to have pressure on your costs with commodity prices. They tend to move hand in hand.
Okay, so I want to get into the business model a little bit more. I believe you did 3 transactions in the last year, one of which was the largest streaming deal done in like nearly a decade, if I've got that right.
Yeah, you couldn't have said it. I couldn't have said it any better. Yeah, it was Montage Gold. It's in Côte d'Ivoire. It's our second investment into Africa, but it's with the Montage team on the Koné project. It's for us. It's a bit of a unique one because it's the first time that we supplied just about the entire capital. Now I say that our biggest flagship asset, Salobo mine down in Brazil. That was a $4 billion build, and we supplied $3.1 billion of that $4 billion. So we supplied a lot of the capital, but not all the capital. Well, this Montage deal in Côte d'Ivoire, we're supplying pretty well all the capital. Zijin's putting in a little bit of money. They're one of the other shareholders in the company, one of the shareholders in the company. And so, but it's one that actually moves the needle for us. And when you get to a company of our size, it's tough to deliver, especially in today's environment. We're not seeing a lot of reinvestment. We sure seem to be doing a lot of gold streams on gold mines lately, not gold streams on copper mines. Then we're not seeing a lot of. So to have something of this size and scale we're pretty excited about it. It's a good, strong, promising project. We like the jurisdiction. It's an area that we're pretty comfortable with. We do have good protections in our agreement to keep us safe from that perspective. And looking forward, the team that's running Montage. Good, strong shareholder support. The Lundins are significant shareholders. Zijin Mining's in there as a significant shareholder. The team that's running it is a team from Endeavour Mining, who's a great success in Western Africa already. So it's a project that we're really excited about. We expect to see production from that mine 2027. And to our credit, we'll be getting about 60,000 gold ounces a year from that mine. So really excited about this one.
Okay, so that's kind of the deal structure there. You invested $650 million this year. Mine goes to production in 2027. What you're expecting to receive initially is around 60,000 ounces, gold equivalent ounces per year.
Yeah, it's a bit of a unique one because normally when we invest into a stream, we carry sort of a residual interest for a long time. But when they approached us about sort of replacing the project debt on this one with using a stream to help fund this, we bumped it up to reflect what project debt would look like on an economics, in the sense that for the first 6 years, we get 20% of the gold. And that's essentially what it would take for them, depending on the commodity price, but it would take for them to pay off project debt going through in a normal course. Obviously, commodity price could have a big impact on that, but they decided to take the plunge on this. And so we get that 20% for first 6 years, then it drops down to 10% of the gold for essentially another 4 or 5 years, and then it drops down to 5%, and the 5% is life of mine. And so ultimately, in the long run, we'll, for the first 6-7 years, we'll be getting 60,000 ounces a year, and then it'll drop down. But with the trend in gold prices, we're pretty excited about what the price of gold will be in 2027 when we start seeing production. We're pretty optimistic on this one.
That's right. Okay, so if the price of gold goes up 2027, this deal becomes much more favorable when it starts delivering. Since I introduced you as somebody who's kind of in the same seat as we are, looking for the best investments in the gold sector, how do you get to the know, Randy? What are the red flags, key things you try to identify when you see a new opportunity? And maybe just to give us some context, you did 3 deals last year. How many do you think that you looked at?
Yeah, our team does paper studies of anywhere between 40 to, I think probably the busiest we've been, about 60 or 70 opportunities per year. A lot of those will go to a sort of a secondary stage. I'd say in the end we get to the site visit stage on about 10% of what we look at. And if you're at the site visit stage, the one thing COVID changed is nobody runs auctions with multiple companies doing site visits now. You get to the sort of final stage, and the site visit's kind of a sign-off with the final company. So site visit is farther down the path than it has been in times past. And so I'd say about 10% of what we look at gets down to that. So the 3 deals we did, we were probably 30 to 40 opportunities we looked at last year. I will say we're not seeing as many. There has been a real lack of risk capital in the early stage side of the mining game, and I just we're generally seeing gold opportunities. We're not seeing companies take the risk on copper opportunities because the capital costs are just so high, and with copper still hovering around $4, $5 in that range, people aren't taking the plunge on advancing these things into production. And so the gold sector is the only place we're seeing investments, and gold mines are typically call it $700 to $1.5 billion capital spends. Not as big as the $4 to $5 billion copper spends you see out there. We're not seeing any in that space. And so, the selection, the opportunity set is probably smaller than what we've seen in a long time, and it's tougher and tougher to find the jewels in there, to find those good projects. There hasn't been a lot of risk capital coming into the space, and without that risk capital, new discoveries aren't being made.
So we talked about this a lot on stage yesterday, this starvation of capital in the metals sector. That's what Randy's talking about. There's been a lack of risk capital moving these deposits towards production to when they would be a fit for Wheaton Precious Metals. And that's reducing the opportunities that you're seeing because these projects just aren't moving forward. Right.
Yeah, our company invests at the development stage. You've got a pre-feasibility study, you've got a scoping study. That's when we start talking. And on projects that we like, we'll even advance some early capital prior to construction. Although we try and keep the majority of our investment post-permit. But what we always find is the toughest time to source capital is right at that stage when you're finishing off your feasibility study, the last capital you need to get to that point to make a construction decision. Once you've got a bankable feasibility study, it opens up other options for financing. And so we just felt that there's an opportunity for us to step in and be supportive through that earlier stage to try and open up opportunities for us, but also support the industry in terms of moving these projects forward.
Okay, so a couple last questions. First of all, when you're looking at a streaming company, you want to look at the current financials, but also the project pipeline. We just walked through the Montage Gold deal. That doesn't actually start delivering value until 2027. So walk me through that pipeline as much as you want to, as far as you want to. Give us maybe the 5-year outlook, Randy. Where's Wheaton today? You're generating just over $1 billion in operating capital. It's not bad. But where are you headed in the next few years here?
Well, our official guidance has us going from, somewhere, our official guidance for last year was 550 to 620. We're definitely, after 3/4 of production, we're definitely going to finish off in the upper end of that guidance. And so it's been a good year. And of course, commodity prices have also helped, seeing record prices last year in gold and still feeling good, strong momentum in gold. What's exciting is that we're going to be climbing up to 850,000 ounces a year, 900. And when you add on the acquisitions we made last year, we'll be well over 900,000 ounces a year by 2029, 2030. So, we're talking about a 50% growth profile over the next 5 years. For a company of our size and scale, that's very rare to have that. And these are the bulk of that. I would say a large portion of that is expansions and improvements that are existing operations. So that's pretty well written in stone. And then another large portion of that is, of course, the construction assets. We've got 4 assets that will be delivering metal to us this year. The one I'm most excited about is Blackwater, right here in BC, with Artemis Gold, Stephen Dean and his team. Very close to pouring first gold there, and that's an asset that will deliver good, healthy production for us, about 40,000 ounces a year when it's up and running. Stephen talks about how much better he's going to make it over the next couple of years, so we'll see where it ultimately winds up, but it's a great project coming on. We've also got B2 Gold, Clive Johnson's building the Goose project up in Nunavut for us, so we'll see some production from that later, last half of the year. Mineral Park down in Arizona will be delivering production for us. And then finally, the Platte Reef project, which I'm really excited about longer term, but they expect to start production before the end of this year down at Platte Reef in South Africa. It's going to reset the platinum palladium market. It is a very low cost, very high production, high quantities of platinum and palladium. And it's a safe mine. It's going to be mechanized, bulk mining, underground, deep underground, which we compare it to most of the other mines down in South Africa. That's going to make a big difference. It's going to be a true differentiator down there. We expect them this year to be ramping up to about 1 million tons per annum through the shafts, but by 2030 they should be at about 10 million tons per annum. So we expect to see big production from there. Most of our production from Platte Reef is actually gold. The bulk of the value is the gold byproduct from this platinum palladium. So we don't have the same price risk on platinum and palladium. Our focus is more on gold. So all of those assets, we've got a long list of other assets that are coming into production over the next 3-4 years, and so it's all going to deliver to one of the strongest growth profiles and solid, locked in. We're not relying on one asset or 2 assets. We've got about 15 assets delivering that growth over the next 4 or 5 years.
Who was in the speaker hall last night when young Isabel joined me on stage? The 9-year-old girl that I met on the floor who told me I needed to look for income and yield. She was carrying around a copy of the cash flow quadrants and had read it. And she joined me up on stage. She was so happy to be here. I had a little VRIC hat on. It's too cute. Her dad was amazing. She came up on stage with me, and I said, we just started chatting about, how she ended up here. Her dad bought her chickens. She raised the chickens. She sold the eggs and invested the capital. She's generating $45 per month for herself right now. 9 years old. Anyway, she was on stage talking about the importance of yield. And that's my next question for you, Randy. So you've been aggressively looking for transactions the last few years. You did 3 last year. One was very large. But what can shareholders expect, prospective shareholders expect from Wheaton over the next couple of years? The same level of searching and aggression, or what are you looking forward to?
Well, in any commodity that's cyclical, there are times to buy and times not to buy, right? And so, I never want to put a commitment to how many acquisitions we're going to make because it all depends on what the market's like. We have to be sensitive to that. Currently, we are still very bullish on gold prices. We see continued growth in demand worldwide. The U.S. dollar doesn't have any fundamental strength behind it. It's just stronger than everything else. That's the only reason it's the strongest reference currency in the world. But the opportunities for gold to step up and play a more major role in financial markets around the world are incredible, especially the transition towards digital ownership of gold, which is coming. And when that happens, I really do think that the opportunity for gold is incredible. And so, I just, as we're building our company, we're always going to, continue investing that. I think the fundamentals are actually stronger for silver because silver's got the benefit of some very healthy industrial demand. The greener we want this planet, the longer we want our microphones, our phones, our electric cars to last. The more silver you use in these things, the better they work, the less energy we waste. And so silver is going to play a more and more important role all the time. And, if the retail space wakes up and starts investing back into it like a precious metal, silver will outperform. But I always caution everyone, silver outperforms on the way down too. So you always have to be sensitive to that. But, in terms of the opportunity set going forward, we're generating a lot of cash flow. We're looking constantly for opportunities. Our office is right across the street. We're a Made in Vancouver success story. And so I've seen a healthy string of companies coming through here with all the conferences in Vancouver. They're coming in and presenting their stories. And, I'm hopeful. As Jay, as you've said, we're generating well over $1 billion in free cash flow. We got to put it to work. If we don't put it to work, it goes to the dividend. We have committed to a progressive dividend. We already return more of our cash flow, significantly more of our cash flow than any other company in the mining space, in the precious metal space, including the other peer companies, the royalty companies, traditional royalty companies, but that's just going to continue to grow. But it really comes down to it either our preference is to put it into the ground into good solid assets, good solid acquisitions. But if we can't put it in the ground, we add it to the dividend.
They return it to shareholders via the quarterly dividend. I think it would meet Isabel's criteria. Randy, thank you so much for joining me on stage today. It's an absolute pleasure as always. Let's give it up.
Thank you, everyone.